Hi, everybody, and welcome back to video number 7 in chapter 23. And when we left off, we were looking at coverage ratios, and here we have 4 of them. First one is the debt to assets ratio, and pretty easily we can see that this is total liabilities divided by total assets. There's also a debt ratio and an assets ratio, and a equity ratio. So we'll get to that here in a second. But number 13 times interest earned, here we take net income, add back interest expense, add back income tax expense, and then divide that by interest expense. And that essentially tells the bank and you how many times you can cover your interest payments with your operating earnings. Then in number 14 here, we have the cash debt coverage ratio, and that's net cash provided by operating activities. We're going to divide that by the average total liabilities. And that, then we have number 15, which is the book value per share, and that's the common stockholders' equity divided by the outstanding shares. All right, some of the limitations of ratio analysis we'll look at here. First, there is certainly the fact that it's based on historical costs. And in some cases, we use estimates. And achieving comparability among firms in a given industry is sometimes difficult. And there's a substantial amount of important information that is not included in the company's financial statements. So if we look at some of the techniques of comparative analysis, here we show an analysis of Acctg chemical over time. So it shows where it started 20 years ago in the way of net sales and revenue and other and net income, and it shows how much it's improved over the last few years. But in the last 4 years or so, it's been pretty much achieved its, shall we say, its maximum. So here, if we look at other statistics, we have earnings per share on common stock, a very common metric used in valuing stock. Our cash dividends per share on common stock, cash dividends declared on common stock. In some cases, we have stock dividends, and taxes, wages, cost of benefits, number of employees, and additions to property, which has been quite significant here. And that's adjusted for stock splits and stock dividends, as we described in the prior chapters. All right, techniques for percentage analysis. Here, analysts also use percentage analysis to help them evaluate and compare companies. Percentage analysis consists of reducing a series of related amounts to a series of percentages of a given base. For example, analysts frequently express all items in an income statement as a percentage of sales, or sometimes as a percentage of cost of goods sold. Rarely, but sometimes. They may analyze a balance sheet on the basis of total assets. Percentage analysis facilitates comparison with other companies and is helpful in evaluating the relative size of items or the relative change in items. A conversion of absolute dollar amount to percentages may also facilitate comparisons between companies of different sizes. All right, so here's what we call horizontal analysis in percentage terms. So they're given some data here, and they note the change in percentage here, horizontal analysis. So if we know the cost of goods sold percentage here, net sales would be 100%, and gross profit would be the difference of 100% and 17.6%, for example. And this is just what we've done here. Here's the income statement and a vertical percentage analysis. Quite often done in our income statements. And here the net sales is 96%, where total revenue is 100%. And then they express everything here as a percentage of total revenue. And net income is 9%. Okay. Quite often we show, differentiated from this schedule, net sales at 100% as well. But in this case, we had some other revenue, so that added to the 4 percentage points to that total revenue. All right, let's take a look at comparing disclosure requirements under GAAP and IFRS. Here, similarities are that GAAP and IFRS have similar standards on post-statement of financial position, subsequent events. That is, under both sets of standards, events that occurred after the statement of financial position date and which provide additional evidence of conditions that existed at the statement of financial position date are recognized in the financial statements. And number two, like GAAP, IFRS requires that for transactions with related parties, companies disclose the amounts involved in a transaction, the amount, terms, and nature of the outstanding balances, and any doubtful amounts related to those outstanding balances for each major category of related parties. There are more similarities, and here, following the issuance of IFRS number 8, operating segments, their requirements under IFRS and GAAP are very similar. That is, both standards use the management approach to identify reportable segments, and similar segment disclosures are required. Number two, neither GAAP nor IFRS requires interim reports. Rather, the SEC and the Securities and Exchanges outside the United States establish the rules. In the United States, interim reports generally are provided on a quarterly basis. Outside the United States, 6-month interim reports are common. Differences include one here, due to the broader range of judgments allowed in more principles-based IFRS, note disclosures generally are more expansive under IFRS compared to GAAP. Number two, subsequent or post-statement of financial position events are under IFRS are evaluated through the date that the financial instruments are authorized for use, quote unquote. GAAP uses the date when financial statements are issued. Also, for share dividends and splits in the subsequent period, IFRS does not adjust, but GAAP does. Number three, under IFRS, there's no specific requirement to disclose the name of a related party, which is the case under GAAP. And finally, number four, under IFRS, interim reports are prepared on a discrete basis, but GAAP generally follows the integral approach. And that ends chapter 23, and that also ends the number 2 course in intermediate accounting. I hope these PowerPoint reviews are helpful, but I also would encourage you also to be sure to read the chapters carefully after going through these PowerPoint summary presentations. All right, that concludes my presentations.